I'm so excited to have my good friend Dustin Lester back. Today, we break down the Jim Harbaugh case. If you haven't seen the split dollar case, it's absolutely incredible. Dustin and I get in a great conversation and talk all about where this case could be used and why more people need to know about it.
In August 2016, University of Michigan announced that it amended its contract with head football coach Jim Harbaugh to include a creative deferred compensation alternative involving cash value life insurance. It made Jim Harbaugh the highest paid college football coach in the country. What most people don't know, however, is the compensation strategy was designed to provide Harbaugh with millions of dollars of tax-free cash during retirement. Okay. So instead of deferred compensation agreement, Harbaugh and Michigan entered into a split dollar loan agreement under which the university agreed to make 7 loans to Jim for $2 million each. So this is a 7-pay structure, between you and me, right? All go into the contract. Okay. Mm-hmm. As long as the policy remains in force, the loan will not have to be repaid until Jim dies, until Harbaugh dies. At which time Michigan will recoup its original $14 million investment, and Harbaugh's beneficiaries will receive the remainder of the death benefit. So basically, that $14 million loan, he's got to carry the interest. That's his cost.
It's called is that called punitive tax or punitive interest?
No, it's just tax. He's got to pay the interest with after-tax money, or it capitalizes. But in this design, it looks like hold on. Well, they're saying that once the loan is extended and capitalized, they expect it to reach 21 million of reimbursement at death from the death benefit instead of the 14. So he's not even paying the interest, but he's probably getting taxed on the economic value of the interest and of the policy.
But do you think Michigan's paying him like an extra bonus to cover that tax too, or is he just picking that up?
The loan, I think he has to pick that up, or he's getting it sent through in a form of a 1099.
Okay.
It's like phantom income.
So walk us through the scenario, right? So you have, you just take it like from the top, like who's paying what and who's paying tax?
I borrowed, first of all, University of Michigan is a nonprofit, so they get to access money tax-free no matter what, right?
Okay.
They're loaning him $2 million.
Now, why would they? 7 years.
Yeah. Now, why would they do that? One, because they can go to any of their credit facilities and get $2 million at no cost right away and give it to him. Mm-hmm. Okay. That's one, so again, they could just pay him that money. 2, why would they do it? They get their money back. When do you pay compensation to people and get it back?
Yeah.
If you're the owner of the business, like what? I get it back. Yes, get it back. Like that's ridiculous. So if you're the business owner and you want to do this for somebody, now again, Jim Harbaugh is a young man. You gotta have now the University of Michigan, they don't care how long. They're gonna be here in 300 years. I mean, they think they will, right? But you understand my point. And so why would they do it? They get their money back. Instead of paying this guy $14 million and having him walk out the door, they lend him $14 million and let him walk out the door. That's a huge thing that nobody talks about, because It's like, what do you mean? Why does Apple care how long one of their executives lives? They don't. Eventually they'll get the money back. And that would never have come back to them if it was normal compensation.
So split dollar arrangements are ways for entities to compensate highly compensated executives and recoup that compensation from the death benefit when they pass.
This is very innovative. When this first came out, we didn't think they would stand.
So what does Jim get from this? Why did Jim's advisors want this for him?
Jim gets $14 million invested, of which he could then have the arbitrage of the returns inside of the contract versus the cost of the loan, just like any other financing situation.
Okay.
What kind of income can you take off of? I mean, this is saying that over his life, the loan would capitalize to 21 million, but let's say that the cash value at that point was 30 million.
Does it say in there what the projected cash value was going to be at his retirement?
It only said that the residual loan death benefit has to be at least 1.1 million at the end.
Residual loan death benefit.
Residual death benefit must be at least 1.1 million following Harbaugh's attainment of age 70.
And I believe I read in one article they use whole life.
And this article says that FINRA details the exact life insurance product was not made public. Harbaugh's medical underwriting wasn't made public, and his plans for income and taking cash out was not made public. So we don't know the distribution model, but that's where his benefit comes in.
Okay.
If you own a $30 million cash value policy and you make 4%, how much did you make? 1.2 million.
2 million.
Right?
Right.
He can now borrow that out to himself tax-free. He can lend it to himself.
And so he gets to take
he gets the income.
He gets the income tax-free through the form of loans if he does it properly as a loan.
Right. So
and he end up with some form of death benefit as well.
Right. Yeah.
From paying back the loan.
The net death benefit has to be above the loan, always 1.12 million.
Do you think if advisors help their clients' employers to structure compensation in this manner, that an employer would be incentivized to pay someone more than just regularly compensating them?
They have to have a very long time horizon with the way they think. Because they're carrying 14 million of loans to this guy in this example for 50 years.
I wonder if the loan was set up like a life insurance financing loan where the creditor is allowing the interest to just compound, or they like balloon it up front. And then like, do you think anybody's paying that creditor the interest along the way, or are they getting it all at the end?
If I was Harbough, I would be paying the interest because he's paying the tax on the payment on the interest anyway.
So you might as well pay the interest back, get that out of the contract from compounding.
Because next year it's going to compound even more and you're going to have a bigger tax bill. But you can do it if the plan supports it. Again, remember, this was sold in 2016 when interest rates were 0. This could be blowing up.
Right. I wonder how this plan's doing now.
Now, if I was Jim, I wouldn't have said this is a floating rate loan, because they probably originated the loan at University of Phoenix. So they probably have this at like a 1.5% interest rate.
University of Michigan, yeah.
Because again, what does University of Michigan get? They get all their money back.
Right.
Okay, that's big. That's a big fucking deal. But they have a different time horizon than you and me. They have a different time horizon than our client who just owns a concrete company and has a great salesman.
Right.
You know, can you structure something for them? Absolutely. But I think what this is going to be used for is higher end, big dollar kind of things where, again, who gives it? No one's even talking about a Roth IRA at these numbers. What's the income on a right? Why do people do this? It's because the regular plans are not for them.
Yeah.
They're for you, me, everybody who's starting out. But once you get into the clouds, like, oh, okay, I'm going to get an $18,000 write-off. Well, the guy's making $9 million a year. That's like him. Literally, he wastes time picking that money up.
Yeah.
And so that's what I mean by, like, I think yes, but not in, not in the sense of like, you're not going to see this I think a church, perfect.
Yeah.
Why would the board want to do this? Okay, well, we've got, unencumbered property all over the place because we're a mega church, we're Christ Church of the Valley or Grace, one of these big suckers, Would the board of that church rather pay out $500,000 to the pastor a year in deferred comp or in just comp, or structure something like this where they could lend the money to the pastor?
Yeah.
And then with the death benefit, all of that compensation comes back into the church when the pastor's passed.
Amazing.
So again, it's like, it isn't whether the product is good. It isn't whether the structure is good. It's if the client is good for it.
Yeah. That makes total sense. Dustin, thanks for taking time to unpack this case study, man. That's a cool one to talk about. If you have questions about split dollar agreements, can they reach out to you?
Yeah, they can reach out on it. But you need a lawyer.
Yeah.
I'm not a lawyer.
Yeah.
I'm not messing around in that world for you. And I don't have the E&O for it, but I understand what you need.
Yeah.
But it's more like, to evaluate whether it's appropriate for you to go through the expense and even exploration of it, talk to us first, and we'll walk you through the covenants. We'll give you an example case. We'll walk you through the expense and cost, and then you can kind of see from there whether you want to start assembling the team. Because you need a good accountant. You got to do it all right. You got to have people who understand this type of business.
That's awesome. I appreciate it. Thanks, man, for taking time to go through that.
Thanks so much for watching this video. If you enjoyed it, check out this other video Dustin and I made where we talked all about variable life. It's a video that's not really found a lot on YouTube channels to talk about life insurance. I think you're gonna get a lot of value from it.